Alright, look, I'm going to start teaching you about equal highs and equal lows and liquidity, but first, there's a few things you have to understand. Number one, the market is rigged. It's 100% rigged against you, and it's anything but efficient, engineered to exploit dumb money. It's the retail trader, aka dumb money. I used to be one too, but you have to understand that smart money, the informed traders that are in this circle, understand a few things that I'm going to teach you. ICT, Inner Circle Trader, has so much content, and that's why I'm making these videos to break it down into an easy and understandable content. I'm talking every single video he made, I've watched and studied. And the things that I've learned, I want to teach you. There's an algorithm that creates and seeks liquidity. The algorithm's name is IPTA. IPTA seeks liquidity in the form of stop losses. In this video, I'm going to go over equal highs and equal lows because I think they're the most important and the most powerful and the most overlooked concept there is. I have an example here. This is an example of equal highs, abbreviated EQH. This is the retail pattern known as the double top. Alright, and here we have the equal lows, or known as EQL abbreviated. It's a retail pattern, the double bottom. Alright, so as traders go short, they play stop losses. The first time as it goes up, stop losses as they go short. The second time, even more stop losses. So this is where it becomes really powerful because there's so much liquidity created and pulled up above those highs. Okay, so if you see two equal highs left behind and they start heading back up, you know that's where the market is going, or known as the draw on liquidity, because now those stops are going to be attacked. And as you'll see, it will break through. That's a run on buy side liquidity. So why don't we just go ahead and jump in the charts, and I'll show you some examples and what I think about them, how powerful they actually are. Alright, so here we have an example of equal highs, whereas retail considers it a double top. So they think this is a double top and it's resistance. Smart money, we think they're equal highs and there's liquidity up there and the algorithm's going to push it up there so very large traders can get out. Sorry, so what's happened here? So the price comes up, creates a high. This is a 4-hour chart, gets rejected, and then puts in 3 pushes down, then comes up, almost takes it out, but it just leaves it there. Why would they leave it there? Because now anyone that was short from here or here and saw it get rejected a little bit, they've been adding on new positions. And where are they going to put their stop? Right up here somewhere. And now this is a buy side liquidity pool. We call it buy side because if you're selling short, your stop is going to be a buy stop. It's going to be buy stops. So now traders that went long here, they didn't get stopped out, so they're still in the position. And then traders that went long here in this order block, it did grab liquidity right here and then just blast off. Now all these traders are taken out of their trade. Now smart money would be looking to go short up on some kind of setup here. So now boom, what happens? It takes the liquidity. So this is a good way to envision it, is if you think of it as like a pool, like an actual pool. Let's go to the tools here. And this is a good way to think of it like this. Just a bunch of buy stops sitting up there, thousands of them. I mean, this is a 4-hour chart. ICT taught me, and is that these retail concepts are bullshit. Like if you think a double top is a good spot to go short, no, you're likely to get ran on any time frame. This just happened to be 4 hour. If this was a 2-minute chart, this would all happen in an hour. If it was a 15-minute chart, it'd happen in a day. Alright, so then it takes the liquidity. Then where do you think its next stop's gonna be? Boom. See how it takes it out? That's because there's a liquidity pool here. If you follow me on Twitter, which these are what these videos are for my Twitter followers, because they're awesome. And I really like the community on Twitter. I feel like it helped me a lot, so I'm trying to get back to traders on there. That how I was when I first started learning his concepts. Because ICT's concepts are deep, and there's so much content. I mean, I was able to go through it because I had a boring ass job that allowed me to go through all this content. Like I was allowed to be on my phone. So all day, every day, I would watch his videos. I would take notes while I'm watching it and study. To be able to go through all his content like I did, it's gonna take a lot of hours. I mean, I don't know how much content he has on his YouTube channel, but I know it's 5 months worth of watching 8 hours a day at least. And there's equal lows down here. Then there's a good chance after it takes that, that's going to be its next stop. Not see, this is where a lot of traders get confused. They're thinking that this is the target, that this fair value gap, which I mean that is a good target if there wasn't the equal lows down here, because that's not liquidity. That's a void that needs to be filled, but it's not liquidity itself. It that needs to be filled, yes, but these equal lows and these equal highs, these are liquidity itself. Thousands of orders, thousands and thousands of orders. And what's the algorithm's job? IPTO's job? It's to create and seek liquidity for smart money, hedge funds, really big traders to be able to get in and out of the market. If you have a position on that's 100,000 ES contracts, this isn't going to help you get out of that position. It's not. But this is, because there's stops here. This is over 2 weeks of trading right here. There's thousands of the market's in a downtrend. And then they leave equal lows behind. I start looking to be able to scalp. I'll be looking to get short somewhere. And if I see other like equal tops near that, so then after this gets taken out, I would be looking to get short right here. It's a little mini turtle soup. All right. So there we go. So the market comes down and then goes back up, leaving these pretty equal. It did take it there a little bit. And then once they leave that, that's like I start salivating. I'm like, okay, here we go. And then I will look to go to get short. As soon as it crosses that, I will look to enter short. Maybe one or two contracts, ES contracts. As soon as it goes there, I sell one, and it keeps going up a little higher, I'll sell two. And then once it goes back through, like right about here, that's when I'll add the other two. And then as it goes down, I'll probably take one off about right here. And then I'll just keep. So I enter two here, so my average is probably 52. And once I get down to like 47, I take one off. I take another one off. I take another one off. And then I'll leave one on for the final target. And that, 4 contracts from here to here, that's 15 points. So you take one off at 4 points, 6 points, 10 points, 15 points. That's a lot of points added up. I mean, that's enough. You're done for the day, really. You don't even need to take another trade. The volatility is so insane that you can make so much money so quickly. I think that's what's troubling a lot of traders, is that they're continuing to trade after making bank in 5 minutes. Like just chill for the day, you're done. Or wait till afternoon. That's what I do. So I'll take a good trade in the morning, and then I stop. I'm not interested in trading for a while. All right, back to the equal highs, equal lows. Let's go to 1 hour because this is my favorite time frame. This and the daily for finding these kind of setups. And so this is another one. See this little baby one right here? This might get overlooked by someone else, but not me, because like I said, I think the equal highs and equal lows are the most powerful, underused concept that ICT teaches. All right, so the little baby one right there, price comes down, and then it just kind of there's a fair value gap rejection, and then you have equal lows right here. It's all in the charts. If you guys just open your eyes and look for it, it's everywhere. And every time this happens, this is retail just getting smacked. They're just getting smacked every time this happens because they think it's support. They've been taught, and we were taught, that this is the best support you can find. If it gets rejected there, the next time it comes down, it's more likely to get rejected. I do think they say like the more times it gets hit, eventually it'll get broken through, but they don't ever talk about liquidity. They don't think I was just arguing with the dude on Twitter about this. They don't think liquidity is why the market moves places, but that's exactly why it moves. It's manipulated, rigged, 100%. It's just what it is. And if you guys are going to be able to trade ICT's concepts, then you need to understand 100% that the market is rigged. There is an algorithm that moves price, and once you start looking into it, and especially once you watch it live, like you watch this happen live and you like see it, you're like, oh, there's a equal highs. Then you're gonna watch it go there, and you're gonna be amazed because it works. It works on every time frame from the 1 minute to the hourly. Let's go to the daily chart. All right, so I was able to call this right here. Once we went down here, everyone was thinking we were going lower to fill this, but I kept saying no, no. It's gonna need to clear out these highs. And same with this equal lows that are right here. When we're up here, there was another set right there. So I knew once we got up here, we were going to come down and clear out at least these. So we came down, cleared those out, didn't take out the liquidity here. So you see that? I have that other mouse turned on. See that? How it just left it there? Yeah, it just left the low there. Didn't take it. Almost. But then once it left it and it came back up here, I was like, no. No, 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 no. This was just a 1 day move. CPI report. And once it rejected and went back inside the range, I was able to call it. I've been calling for this to be hit for since this was put in, since these were put in, it's almost a month now. So now are you guys starting to see how the market moves for liquidity? It's moving to where the most liquidity is at. So I think that's the most important thing to understand when you're trying to learn his concepts. They're deep, but there's a lot of the main concepts that are pretty simple that can tell you where the market's going and give you trade setups. Because of these equal highs being cleared out, you can start to get short. Obviously, I don't trade the day time frame. I just use it as like a direction. So if I'm thinking we're gonna go down, then I'm gonna start looking for shorts, especially in the in the morning. Let's go to the 15-minute time frame and just take a look at there. I like the 15-minute time frame. It likes to overshoot the fair value gap, so I do use it for analysis, but I don't trade off it or use it as point of interest. If I'm gonna use point of interest, it's gonna be the 1 hour chart. Let's go back in time, so I can just keep. I want to give you guys enough examples to where You feel motivated to go look in your own charts. You go right here, and if you're in trading view, you push shift, it automatically makes a straight line for you. Sorry, let's say you were in this trade, or you were looking to get long in this area. So price comes up, takes out the liquidity here, immediately drops down. It's filling this fair value gap that's right here. All right, it leaves the equal highs. Let's just move that out so we can see a little bit. So it leaves them here, right? So this is right at the opening. It does this. If it was dropping back down in here, and I know that it left those, it left them on purpose. Like it didn't do it on accident. It's not just random. The algorithm pushed price up there to induce liquidity. So then you have an order block here. And then that's where I'd probably be looking to get long somewhere. If you measured here, this would probably be OTE somewhere in here. There's probably a fair value gap in there on the lower time frame. And then another thing, you see how see how it's exactly even with that? When I see that on the smaller time frames, I'll start looking to get long if I see that happening often on like a 2-minute chart, because it's a sign, because that's too exact. Like that wasn't an accident, you know, like that price came down there. I see it all the time. You could say it's random, but I don't think it is. That it ticks down exactly to close the last full body candle before. All right, anyways, back to the subject. So equal highs, if they get left, you need to start looking to get in line with the smart money in the algorithm. It's not smart money we're trading with, it's the algorithm. So we know the algorithm is creating and seeking liquidity. So we need to be in sync with the algorithm and trading with it, not against it. Say if you tried going short all throughout here, you're just getting wicked up. None of your trades are working out very well. All right. Just looking as I was talking to you guys. So here's another example. This is inducement. They're inducing liquidity. It comes up. Like they took it out by a little bit, which on a smaller time frame, that would be like a turtle soup kind of. So you actually have 1, 2, 3, 4 highs. So they just keep coming up here and dropping them back down, letting the shorts get in, let them put their stops where they think they feel safe, and then it just continues to create the liquidity here. And then finally, see if I saw this, I saw they left these equal highs up here, and they come down and they take, and then there's a run right here. All day long I would take this trade. I would get in 2 contracts as soon as it runs that. Like a lot of people ask me like, well, how do I trade it? As soon as it pops below that, I'm slapping a contract on ES long, and then I'll smack another one as it comes down a little bit more, and then once it goes up, then I'll enter 2 more, and then I'll put my stop point at the max. So what I'm risking, my average is probably a 4.5. We'll put the stop down here. So I'm risking 4 points with my 4 contracts, because my average is going to be somewhere in the, probably right in there at 85.50, and my stop's 84.50, a point below it. So I'm risking 4 points, and once it starts going my way, 3 or 4 points, I get sell into strength. So there's 4 points. So now the other 3 contracts on are risk free. They're risk free. Like if I get stopped out, I don't lose any money. And so now I'm risk free. So as we take out this high, I'll take one up. So there's 2 points profit, and I still have 2 more contracts. And I know that this is the ultimate target. So as we come up, we take out these equal highs, these little baby equal highs. We take out there. So there's 91.85. So we're at 8 points profit total. We have 3 contracts off. We have one left to get off. And as we push up in here, I'll sell the last one for around 9 points. So that's 17 points of profit, which that's enough for you to be chilling for the rest of the day. 17 times 50, that's $850 trade. The next series, or not series, but the next episode is going to be on daily highs and daily lows. I'm just going to go through the basic concepts that I think are important, and then once I have you guys all up to speed on the basic stuff that I think is important, without it you can't take your trading next level, then we'll go into trading models, time of day trades, and hopefully I can get you guys to where I'm at, where I feel like I'm in the inner circle of traders. You know, I know where the market's going. I know how to trade it. I want to give back to the community, especially the community on Twitter, and hopefully I build a community just like that here on YouTube. So subscribe,